In this video, I'm going to talk about hourly bias, as there's many people who think when they trade on the 1 minute and 5 minute time frame that they need a daily bias, but they really just need a 1 hour and 4 hour bias. So that's what I'm going to talk about in this video. The first thing we're going to talk about is how do we find the bias? And there are mainly two criteria that we want to focus on. The first one is price delivering from a PD array or have swept liquidity? And for this first example, we see the price is delivering from this busy that is within a discount, which is another bonus. Second, where is the drawn liquidity? And we see that we have created equal highs up here, or relative equal highs, which is a great drawn liquidity. So now, what do you guys think the bias is for this example? The bias is bullish, as we are delivering from a busy, which is a bullish PD array, and we also swept sell side liquidity, which also indicates higher prices. And the drawn liquidity is also higher. Now down here on the 1 hour time frame, we also have to identify a bias. And as we see, we have the 4 hour busy and also the liquidity that price swept. And after we swept the liquidity, we see that we created this inversion failure gap. And price did disrespect the inversion failure gap, but it's still a confirmation for higher prices that price made the inversion failure gap. So in that case, on the 1 hour time frame, price is also mostly bullish. And we mostly want to focus on this SIBI up here, which we want to get inversed. Down here on the 15-minute time frame, we can now start looking for a possible trade entry, as we have identified the bias on the 4-hour and 1 hour time frame, which in this case is bullish. So now what do we see here on the 15-minute time frame? We see the price is starting to deliver from this 15-minute inversion failure gap, and that we also have a possible inversion failure gap at this failure gap right here. So that is what we're going to look for as our trade entry. So right here, price makes a close above the failure gap, creating a inversion failure gap. So if we were to take a trade entry at the close, we would put our stop loss at the low and then target the internal range liquidity. But that would only make a 0.3 risk reward ratio. So in that case, we could actually move our stop loss up a bit, as the inversion failure gap is not that big. But that will still only make a 0.5 risk reward ratio. So in that case, we could zoom out and potentially target the drawn liquidity all the way up here. But that will take a long time. As we're on the 15-minute time frame, it will take over a day. So in that case, we could just target this high up here. As the drawn liquidity is still bullish, so in that case, we could still target higher prices. So now let's see if we have to take a trade entry at this. Put our stop loss at this low, and then target this high up here. And we see the price takes our profit. So now let's see if price also can manage to take out the equal highs that we had up here. And we see the price does takes out the equal highs. Now for our next example, we're going to talk about a bearish scenario. So the first thing we want to look for is price delivering from a PD array has swept liquidity. And in this case, we'll see the price is delivering from this inversion failure gap. So now we want to look for a drawn liquidity. And what do we have right here? We have low resistance liquidity, as we see. So that is mostly what price is going to draw towards. So now that we have identified the bias on the 4-hour time frame, we can go down into the 1 hour time frame and look for the same criteria. Down here on the 1 hour time frame, we have both this SIBI, which it looks like price is starting to react from, and then we also have this inversion failure gap, which price is also starting to respect. So that is the first criteria, which is checked off. So now I want to look for the second one. Where's the drawn liquidity? And we really have the same drawn liquidity as the 4-hour time frame, which is the low resistance liquidity that we have. So now that we have identified what price is also going on the 1 hour time frame, we'll now go down into the 15-minute time frame, look for bias there, then the 5-minute, and down here at the 15-minute time frame, we see that we have a lot of low resistance liquidity down here and also up here, which is our main drawn liquidity for this scenario. So in that case, we go down into the 5-minute time frame. And now down here on the 5-minute time frame, we see that we have this SIBI right here, which is within the OTE of the range, or more precisely within the premium. So in that case, we would like to see this SIBI get respected and then take out some of this low resistance liquidity that we have right here, and also take out the low resistance liquidity that we have all the way down here. So now let's see if the SIBI gets respected. And right here, we see that price respects the SIBI by the consequent encouragement. So if we were to take a trade entry based on the SIBI, we take a trade entry at the consequent encouragement, put our stop loss at a reasonable place where we think the SIBI will get invalidated. So let's just say up here at the high, and then target some of the low resistance liquidity that we have down here, which will make a 2.6 risk reward ratio. So let's see if that would happen. And right here, we take out the low resistance liquidity. And if we were to target the other low resistance liquidity, which we have all the way down here, they'll make a 4 risk reward ratio. And we see the price takes out the low resistance liquidity. Now back up here on the 4-hour time frame, we can see that we really didn't take profit at the low resistance liquidity. And we don't really need to take profit at our drawn liquidity on the higher time frame. We just have to have a drawn liquidity on where we think price is going. So if the drawn liquidity is lower in this case, then we're going to take short trade entries on the lower time frame. So that's how we use our drawn liquidity on the higher time frame. For our next example, we'll see that right here on the 4-hour time frame, price is starting to respect this P array, which is the first criteria. So now we want to look for a drawn liquidity. And what do we have up here? We have these relative equal highs, which is a great drawn liquidity. So already on the higher time frame or on the 4-hour time frame, we have two of the criterias. So now we can drop down into lower time frame and look for the same true criterias to identify the bias. Down here on the hourly time frame, we can already see that price is starting to respect this 4-hour busy. And the way we can see that is price respecting the consequent encouragement by the body. And we'll also see that we have this huge up close candle, which closes above the busy. So in that case, the bias is also clear on the 1-hour time frame that we're bullish and would most likely target the equal highs. And what do we also have? We have low resistance liquidity. So in that case, we have two drawn liquidity. Down here in the 15-minute time frame, we can see how price also respected the hourly imbalance, but we had fast sell side delivery and then fast buy side delivery out of the imbalance. So in that case, the bias is also bullish on the 15-minute time frame, and we mostly like to see price disrespect these two fairly gaps. So now let's go down into the 5-minute time frame. Down here in the 5-minute time frame, we can see how price is starting to respect this bullish PD array. And we'll also see that this looks more like a market maker sell model and then a market maker buy model, as we have sell side of the curve and then buy side of the curve. And another signature is that we had this high up here, which is an intermediate term high, which got disrespected, which is also another bullish signature. So in that case, we can go down into the 1-minute time frame and take a trade entry. Now, finally, down here on the 1-minute time frame, what do we see? We see that price swept sell side liquidity. So in that case, we could start looking for a inversion failure gap, as we have one of the criterias. And what do we have right here? We have a failure gap to be inversed, a singular one. And our 4-hour drawn liquidity is right up here. So this would be the perfect trade entry. So let's see if price could take out or inverse this failure gap. Right here, price inverses the failure gap, so then we could buy, put our stop loss at this low, and then target the equal highs all the way up here. And let's see what risk reward ratio that would make. It would only make a 1.6 risk reward ratio. So in that case, we have to move our stop loss a bit up. But it's alright, as this inversion failure gap isn't that big. So that would create a 2.4 risk reward ratio. So let's see if price could take out the equal highs. And right here, price takes out the equal highs and also makes a retracement down into the inversion failure gap.